Okay, good morning, ARMR insiders. Good morning, all of our ARMR partners. Thank you for joining me for our virtual hedge fund morning meeting. Chief Investment Officer, Portfolio Manager, please think of yourself that way. I'm going to share with you our macro picture. We're going to talk about our proprietary algorithms for understanding market direction. We call that the risk monitor. Simple red, yellow, green coloring tells us the direction of the market from a probability point of view and how we want to manage risk depending on each of those colors. So we're going to go over what that looks like and where it may be going by the end of the week and how it will affect our portfolios. We're going to cover top stocks to watch, top stocks to buy, and with a bit of a focus on individual groups. So a couple of group ETFs are going to be in focus for us today. So before I dive in, don't forget, I'm going to share with you what I'm doing personally, what I'm doing professionally, but at the end of the day, only you know your risk tolerance, what your goals are, what your strategy is. You've got to execute that. Only you can be the smart money of your own assets. So make your own decisions, okay? So before we get to cannabis, yes, we'll spend a little bit of time on the Cannabis Couch. First thing we want to do is go look at the indexes. We've got 10 indexes in our risk monitor. You're looking at 7 right here. The picture's not beautiful, but the market is hanging on by a thread. We know what we want to do, and the whole point of the risk monitor and the whole point of our algorithmic strategy for trading the S&P is to get on the right side of probability when rewards worth risk, and do that over and over again, and performance will follow. It's not that hard. The hard part's actually doing the execution correctly. But understanding how to make money is not really hard. It's getting on the right side of probabilities and statistics and executing the same way over and over again. So 8 out of 10 stocks follow the market. Our risk monitor is yellow right now. We are in the midst of a trade on our pure S&P portfolio, or I should say strategy, SPXL. We're on trade 27. This strategy is up more than 185% since we've been, there's the number, 185+%. That's just on trades since we've been doing this together, live trading every trade together. We're on trade 27. That's just trading gains. It doesn't include the treasury bill interest we collect when we're sitting in cash. So we were on right here on trade 27, and it's kind of been meandering. And now the stop has moved back down to the low of yesterday, which is more or less our entry point. So the stop on this strategy is very simple. It's the low of 2 days ago. And so we just keep readjusting it until we close below the low of 2 days ago. Yesterday literally closed right on it. The last 3 minutes took it a little bit below, but that's right on it. So once again, we close right on the stop. So the low of 2 days ago forces us to shift that stop down to the low of yesterday. And I really like that from just a simple synergistic kind of point of view. The low of yesterday is also the 50-day moving average. So it's pretty obvious. If the market closes below the 50-day, risk monitor will be red. This trade will be over. If the market can hold on here, it shook out Monday and Tuesday. Last week was Fed week. Market's trying to digest that. Shook out Monday, Tuesday. If we get strength into the close of the week, then I submit to you that the probabilities of a year-end rally increase dramatically. Now, the market usually rallies at the end of the year, something like 79% of the time, some ridiculous figure, okay? So it doesn't have to happen, but our job is to get on the right side of probabilities and statistics. And so using the 50-day moving average here for the end of this trade makes all the sense in the world. And if we go to the NASDAQ 100, our other most important index, which doesn't look very good, okay? But you could see that the stop right now on this strategy, which also got long on this day, okay, so the algo is long in here, and the stop is the 50-day, which is really going to be the low of yesterday. So the two most important indexes of the 10 that we follow are hanging on by a thread. They're right on the stop. We close below it today. Risk monitor red. Any more defending of the portfolio that needs to be doing will have to be done. But the probabilities don't favor that, and so we're gonna give it all the room we can give it. Okay. I do not believe the risk monitor will go green, and part of the reason for that is some of the other indexes in here just look terrible, right? We have the Treasury bonds are breaking down. We're going to get to that in a minute. And Bitcoin looks terrible. We can get to that in a minute. Does it make a double bottom? Maybe. But right now it's in the midst of a terrible death cross. Okay, the 50s crossing below the 200-day. All the major moving averages are pushing lower. Bitcoin can't even get above the first Fibonacci fan sequence of downtrends. It just looks terrible. If it actually breaks below these lows, Katie bar the door on the whole MicroStrategy implosion. Okay, this is what's going on in Micro. Now we made a lot of money on this. We bought puts up here, and we covered our puts right down near the lows in here. So I shouldn't say cover. We sold our puts and we booked a profit. I'm of the opinion that the sharks are in the water. They smell the blood, and they're going to make strategy pay. The sharks are Goldman Sachs, JP Morgan, Morgan Stanley. Is it any surprise the Morgan Stanley index is thinking of bouncing strategy out of their indexes? I think ultimately Bitcoin resolves higher, but I think that there's a position in here which is strategy. They're over their skis on debt. They're hammering away on the hapless individual stock owners of their common stock. They're just issuing common stock like crazy to pay dividends on preferred. That sounds like a Ponzi scheme, although, of course, everything's fully disclosed. So everyone whistles past the graveyard and says, yeah, that's okay. Just dilute the common shareholders. Just screw them and pay off the preferred guys. I don't know who owns the common. I mean, that person who owns common needs to have their head examined. But anyway, I don't own the puts down here. But if we were to break down below these lows, I think something's going on here that has to do with strategy and not so much having to do with Bitcoin. But we'll move on. My point is there are too many of our indexes, for instance, the innovative stocks, innovative 50, right? IBD 50, total breakdown, looks terrible, all right? Momentum, struggling, breaking below the 50. So to get back to our risk monitor, it's not going to go green. But if the big indexes hold on here, yellow will continue, and that means we're allowed to take risk. But what we don't really want to do is take risk in big indexes. We want to look for where the rotation is. We've had risk monitor yellow for a few weeks now. What it really means is money is rotating, and I don't know about you guys, but on our desk, we're absolutely killing it. Am I allowed to say that? In all humility, I know the market can turn in a moment, and I'll have to deal with that. But ARMR insiders, ARMR investors, the family offices we manage, we're pushing. Yesterday we took out the highs of the year, and this morning we're making all-time new highs. So our portfolio is going through the roof, and the reason is we're focused on assets that are not heavily correlated to the risk monitor. The risk monitor is kind of really correlated to growth stocks, innovative growth stocks, those types of things, the hateful eight, those types of names. And money's rotating, right? So we're focused on commodities. We can go take a look at 35% of the portfolio is locked up in these 5 ETFs: physical gold, physical silver, large cap silver stocks, small cap silver stocks, and GDX, the gold mining stocks. Okay. Then along with that, we have some select exposure to copper, HBM we're long, which is Hudbay Minerals. We're long Freeport, Macmoran copper and gold. Okay, breaking out, going higher. And then we're long some select financial stocks that focus on precious metals like Sprott, Okay, we've been in spot since down around here in September in the 65 area, traded it all the way up. We're long in here. Okay, stocks trading, what is this, somewhere in the 95 area. We're long gold, which used to be ARMR, and they changed their name to gold.com. You can see why. Perfect downtrend, breaking the downtrend, all three Fibonacci sequences. We're buying the tightly packed and swinging positive moving averages, and it's starting to go. So we have a lot of exposure to commodities and the right commodities, excuse me. Major stock to watch. Okay. I've got Gush on the whiteboard at some point in here, and it's not now. I mean, oil's breaking down. Oil stocks are breaking down. Okay. We're in some strange world right now where silver is trading higher than oil, right? I mean, the last time we saw silver and oil at these prices was not in the 1980s. I think it was 1980. Okay. So stock to watch. I'm not a buyer of oil in here, but somewhere out there is going to be a major move higher in oil. I just don't know when it is. Gush will be my play. You know, it's double the E&P index, and that's the way I'm going to do it. So I'm going to focus on ETFs. And in this conversation today, a lot of discussion is going to be on exchange traded funds. When the risk monitor is yellow, I will buy individual stocks, but I like to get rid of individual stock risk and really trade groups through ETFs. So I reduce my risk a little bit, right? I'm reducing single stock risk, right? I still have risk in the groups, but if I get the groups right, I want to make sure I get paid on the right themes on groups. And so I don't want to do in a difficult market is choose the one stock in the group that goes down, the whole group's going up. So when you're in a risk monitor green, wild bull market, you can throw your ideas out there and the market will save you on most of the bad decisions you make on stocks. But in this market, it won't save you. And in fact, it'll kill you if you're wrong on a stock. So right now it's better for me to focus on ETFs. And hey, you know, they make it easy for me because they have double and triple ETFs, right? 2 and 3x. So I can get massive growth stock type of returns by just getting the group right. And that's where I'm focused right now. So stock to watch is Gush. If you want to know an idea of like every now and then we'll go out there and buy a stock, here's a reason why. We look for a unique situation. All right. So we own all of the ETFs of the silver stocks, but we do have a position in Coeur d'Alene. And so what we're saying here is Coeur d'Alene went down because they made an $11 billion acquisition of New Gold. So while all the other silver stocks are making all-time new highs, Coeur d'Alene got pressured because of an acquisition, and that's a gift to me. Whenever that pressure lifts, there's going to be a geyser as Coeur d'Alene catches up to the rest of the group. Okay? You could argue Coeur d'Alene after that acquisition is a more powerful stock than ever. All right. So here's like Pan American Silver. It's trading up here, right? Coeur d'Alene should be trading up there, in my opinion. And it's still trading down here. So I have a position on Coeur d'Alene. All right. So risk monitor yellow, not going to go green, might go red. If we have strength at the end of the week, great. We'll continue to focus on groups and select individual stocks to put the 30% cash we have in the portfolio to work. Okay. I don't have to put that money to work. I'm happy to carry treasury bills and collect interest, but if I could find the right opportunities, I'm going to put that capital to work. If we get to the end of this week, risk monitor still yellow, markets holding on, and we go into a year-end rally. Okay. Couple of things to think about. Why is gold and silver? Why are commodities running? What I would ask you to look at is the following chart. I'm going to put that up in a second. I'm going to read to you something from the Kobayashi letter that I thought was really good. All right. First of all, silver is hitting new highs above 66 this morning. Gold continues its smooth ascent. Central banks are reshaping the gold market. We already know this, but just to put it in perspective for you, global gold reserves rose 40 48,225 tons in Q3 alone. That's the highest since 1950s. That now exceeds the 1960s peak of 38,000 tons before the gold standard was officially abandoned. Okay, so the official gold reserves have risen to 40,225 tons in Q3. That's global official gold reserves, larger than the 1960s. Non-Western banks have led the surge with an increase of nearly 10,000 tons since 2009. As a result, the non-Western banks now own a record 48% of all central bank gold. Now, if you want to know why they're doing all this, I think it comes down to the global debt crisis. Gold is driving higher to try to keep up with the interest expense on global government debt. And this is the chart that illustrates that. The red line is global government interest expense. The blue line is the price of gold. So there are many out there that talk about constantly, they tell you that gold is at its peak, that silver can't go up anymore, blah, 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 right? They're not really looking at the driving force here. We on this desk have been ahead of the curve. We got you guys prepared for it. We talked about it for a couple of years, that the move for central banks to make gold a tier one asset was going to change this market forever. You can't look at the past and try to figure out what it's worth. You have to look forward. So central banks have made gold a tier one asset. They're using it to protect assets. And there is the reason why. Global government interest expense is going through the roof. Okay, commodities are the group we want to own in a market like this. What are the other groups we want to own? Well, guess what? We're having a dramatically steepening yield curve. And when the yield curve steepens, one of the best groups that benefits from that are banks and brokers. They pay out on short-term interest rates and they lend at high interest rates of the longer term, right? So when you have a steep yield curve, they're lending long-term at higher rates and they're paying out interest on short rates. They get the spread. They've suffered through years of an inverted yield curve. Now is the time for financials. This is one reason why the Dow looks so strong. It's one of our 10 indexes in the risk monitor, and the Dow has been leading. The Dow's got a lot of exposure to financials. Okay. I was concerned about regional banks as they were breaking down, and we talked about that down in here because regional banks were dealing with a liquidity crisis, it seemed. Then the Fed came out last week and said they're going to start quantitative easing and adding liquidity. Steepening yield curve, added liquidity, banks and brokers. That's a group to focus on. Many different ways to play it. The way I want to play it, straight up XLF. We can always do that. I like this chart right here. Looking at the O'Neill chart, it's hitting a buy zone, the pivot zone on the entire financial index. Okay. Or we can go triple. We can go triple. I can buy individual stocks where I'm taking risk on an individual name that blows up in my face, or I could take risk on leverage, right? This is a leveraged ETF. Figure out your risk tolerance. What's your own goal? Don't listen to me. Do what works for you. This is not investment advice, yada, 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 right? I hope we're all mature enough to understand that. I'm telling you what I do personally, what I do professionally, you figure out on your own. But a top stock to watch and buy for me is going to be triple the financial index. And I use the triples. I don't use it to put on massive exposure. I say, how much do I want in financials? And then I put on a position using the triple. It doesn't chew up all of my cash, right? I have 30% cash. I want to put some of the money to work. Maybe I put 10% in triple financials. Give me 30% exposure to the financial space. Then I still have another 20% of capital to put to work in other ideas. So that's how I use leverage. I don't use it to take massive exposure. I use it to manage a portfolio. Okay. So top stock to watch, top stock to buy, to me, has to be financials with a steepening yield curve. Guys, before I get to the Cannabis Couch, and I'm going to get there, the market is at this weird moment, and we're going to see which way it goes. I've just added an AI stock, one AI stock. Okay, so I just bought this the other day. Okay, GEV. This is a company, infrastructure builder, GE Verona, perfect setup, blew out on a doubling of their buyback and a doubling of the dividend, set up a perfect ARMR entry point right in here. I love the 4-day rule. It blows out, pulls back for 4 days. That's when I want to get long. Okay. And then I expect it to move higher today. If it doesn't, my stop is tight, so I'll be out where that red line is. Okay. So this is my entry. The red line's my stop. Reward, breakout from here, risk, minimal. I'm willing to take it. But if I said to you that Oracle was going to be trading down here, AVGO would get hammered on earnings, IREM would be imploding, CoreWeave would be collapsing, and yet the NASDAQ 100 would be holding the 50-day moving average, I don't think you'd believe it. Those are just a handful. Those are just 4. I mean, there's so many I could have listed of AI stocks that are getting hammered, and yet the market holds the 50. Now let's get bearish. We know investment managers are close to 100% exposed to the stock market right now, according to Bloomberg. And another interesting fact, U.S. technology stocks now trade at their highest valuation premium relative to defensive stocks since the dot-com boom. That means XLK versus XLU or XLP, the consumer staples, all right? It's at its highest premium. So we know something's got to give. Something's got to give. But the Fed's adding liquidity. So I go like this. Selective, carrying some cash. I'll take shots where I think the right setup is in a more conservative name. I'm not looking to go out on a limb on risk, but I am willing to take some risk, right? We're long Tesla. I don't think there's a fund manager on earth that calls themselves a growth fund manager who can afford not to own Tesla when it goes above 500. If Tesla breaks out above 500, look at the weekly chart of Tesla. This is a massive weekly breakout in Tesla. It's happening already before 500. It's already happening. How could you be a fund manager focusing on growth and innovative growth and have that weekly chart breakout and not own it? I mean, they're going to have to own it. And I think that there's, as always, rotation inside the Hateful Eight. So while they're taking money out of Microsoft or Amazon or Meta or whomever in the Hateful Eight, Netflix, they're rolling into Tesla right here. So we will take individual stock risk where we think it's necessary, where we think it makes sense. At the same time, we recognize this market is priced to perfection. And it could stay priced to perfection for another 3 months for all we know, 6 months, right? But something out there, bang. So we have to be cautious in our approach. And I'll just wrap up with a discussion real quick on the Cannabis Couch. I shared with you my thoughts yesterday. You can go to the website, go to the YouTube channel. I cut it for you so you guys can see my opinions of the Cannabis Couch and how we're going to trade it. You can throw a comment or a question into this video. I'll try to answer it for you. A lot of guys are talking to me about individual cannabis stocks. I don't want individual cannabis stocks. I don't care about them right now. All I want to do is get the group right. At this stage, the group trade is what I want. In the future, I might drill down and look at other ideas. But right now, the key is to get the group stage right. Lots of rumors flying around. Lots of, ABC is carrying a story that Trump tonight is going to reclassify weed. I don't know. Nobody knows. The only way to make money in this asset. So you guys want to know what I'm doing right now, right? Nothing but enjoying the ride. I'm enjoying the ride. There's no way to buy these stocks when they're up. The only reason why this trading desk is making a fortune on these stocks, and we've traded it well since 2020, is because we buy weakness and we get out of it when it reverses. That's all. It really isn't that hard. We were buying down in here. We booked profit up near the top channel, right? We were buying in the green box recently. Skyrocketed. I told you guys on Friday I was adding more under $5. I shared with you I thought a price under 6 is still reasonable, but I'm not paying 6. Our average price on this desk is $4 and a penny. So my stop is $4.70, and the rest is gravy. I don't know where this is going to go. I own lottery ticket calls. I don't know where this is going to go. I see guys coming out recommending you sell when Trump reschedules. Go ahead and do that. Don't wait for me. It doesn't matter what I'm doing. What's your risk tolerance? What's your goals? I think people have this sector totally wrong. I think people have been destroyed for so long, they can't see the enormity of what's coming in the sector. That's my opinion. And I'm going to trade it that way. I'm going to invest in it that way. I'm going to raise my stops as I go. And if my stop gets hit, I'm not going to force my will and opinion on the market. I'll get out and book my gain. If it keeps skyrocketing, I'm going to be there. What's the point of owning a lottery ticket if I don't get paid lottery gains? So I got my lottery ticket calls cheap. I'm going to see where it goes. At some point, I probably roll them higher, right? I'll take not only my capital out, but I'll take my capital and a profit out. Then I'll roll them higher, so I'll control the same amount of shares with less money and see where this goes. That's how I'm going to end up playing this. All right. What do you got? Any questions for me before the bell rings? How about Visa for a 4-day gap up rule? Let's take a look. Ooh, yeah. Yeah, I like Visa and I like financials, right? Visa's in the XLF index. So there's the gap. It's not exactly what I look for, a ghost dog, but it is a close idea, right? So there's nothing wrong with Visa. I like it. It's breaking the downtrend, and then it pulls back for a tight 3 days, and then you get a follow through today. Great idea. All right, guys, listen. Bell's about to ring. We got 2 minutes left. You guys got a question. I'm happy to answer it. Let me just check my notes, see if there's anything I wanted to go over with you other than that. I don't think so. Here's a couple of ideas for you that are on our list to buy, possible buys, and that's Dow stocks. Okay, Visa, by the way, is a Dow stock, so Visa is a good idea. I'm buying Dow stocks, perhaps. Boeing looks like it's a good setup. Honeywell looks like the GE of the future to me, right? Honeywell's going through spinoffs like GE did, and then Honeywell just looks perfect down here, and it's a Dow stock. So Honeywell might be in the portfolio. And then I think Amgen, another Dow stock, looks like it's set up with a 3% yield. I might put that in my dividend portfolio. That's a nice setup on Amgen. Looks a little bit like Eli Lilly, right? Same type of pattern. Lilly's just ahead of it. All right, guys, those are the ideas for the day. I hope you found this information helpful. Go to our website, armrInvesting.com, if you want to join us. Don't forget, we have a free Substack, armrInvesting.substack.com. That's the bell ringing. I hope you all have a wonderful trading session. Remember, at the end of the day, whatever I've said, it's time to put it aside. Think for yourself, risk tolerance goals, and be the smart money.